Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of Propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to another edition of the Property Buyer Podcast. I'm Rich Harvey, CEO of Property Buyer. You know, the motto of my business model is quite simple. It's to help people make better property decisions. And today I'm joined by Luke Gardiner, who's the founder and CEO of Loans for Homes. It's a boutique mortgage brokerage dedicated to helping Australians finance their way to wealth. With over a decade of experience in the finance industry, Luke specialises in crafting smart lending strategies for home buyers, investors and upgraders alike. He's known for his clear advice, client-first mindset and deep industry insights. Luke's built Loans for Homes as a trusted partner for those looking to build wealth through property. So great to have you on the podcast today, Luke.
Thanks for having me, Rich. Mate, I really appreciate the opportunity.
Fantastic. Now, I'm throwing you in the deep end. We have a thought of the week. We're a little bit philosophical in our podcast to kick it off. And I've got a quote from Alice Walker. And her quote is, "The most common way people give up their power is by thinking they don't have any." What do you take from that quote?
Oh, I love that quote. It's deep, but it's right up my alley. It's actually something that I practice a lot. Didn't when I was younger. I was very, very shy. Didn't have a lot of self-belief as a young kid, but over the years I've worked on that. But I think the mind is so powerful, and we are in control of it. And it's something, that saying, if you can believe it, you can achieve it. I tell my daughter, I'm a father of two young girls. One of them's probably too young to understand, but my 5-year-old, we have these conversations daily, and I always tell her that, you've got full control over your thoughts. You can't really control some of the thoughts that enter your mind, but you can control those thoughts that you let hang there and manifest, and
that's it.
Choose to delete.
Awesome.
She's at the stage now where she's having nightmares, and so I'm trying to give her some techniques to delete those bad thoughts and replace them with positive thoughts. So I love that quote.
Fantastic. Oh, that's a really good insight, Luke. Well, let's talk about some thoughts about the property market, but I'd really like today just to understand a bit about your personal journey. And if it's okay, Luke, could you take us back to the beginning of what inspired you to launch your business, Loans for Homes? What's the story behind getting into finance and broking?
Yeah, sure. Well, look, to be completely honest, I sort of fell into finance. I actually started out in hospitality. That's my background. And even that was something that I sort of just, I fell into that as well, I suppose. I came out of high school not knowing what I wanted to do, and Mum insisted that I go and do something, outside of school, some tertiary education. So I said to my best mate at the time, "What are you doing?" And he said, "I'm doing a hospitality course." So I said, "Okay, great, I'll do that too." And so did a hospitality course. Thought I'd travel the world and work in hotels, but didn't really enjoy the hours. I was working Friday, Saturday nights when all my mates were going out, having drinks and having fun, and I had Monday, Tuesday off when everyone was at uni. So I left that, and I didn't have a job for a while. I was living at home with parents, and I suppose this part might be a bit embarrassing, but my mum actually got me a job as a teller in a bank. She had worked in banking and said, it's safe, it's secure, and you need to do something, you need to get off the couch. So got me a job as a teller, and then, just through, I think, natural progression, I went from, teller, customer service, home loan, sort of just a branch lender at that stage, with a major bank, and did about 4 years there until I was headhunted by another lender, and that's where it sort of really opened my eyes to sort of property investment, and finance, financing property. And I think that's when I met you.
Yeah, I remember you coming along to some of my early seminars, seminars back in the day when we did them in the city, I remember. Yeah.
That's right. Yeah, I was a seminar junkie back then. That was before I was married and had kids. I had a lot of spare time.
I remember you used to ask good questions. You were always very insightful, which I appreciated.
Yeah, no, and I appreciate that. But I think that's where I really sort of fell in love with property and investment, and sort of, I think, realised that this is the industry that I want to be in. And I loved helping people because I was, at that stage, more of a broker than a lender with the group that I was with. And I suppose, cut a long story short, is I had a great boss at the time, and he had offered me partnership in the business, sort of like a succession plan. He wanted to get out and offered me a buy-in. I think it was sort of 10% per annum over 10 years, and then I would be the owner of the business and he'd be paid out and gone. And I found out that he was actually offering to other potential investors. He was a bit silly. He went away on a holiday and asked me to manage the business and redirected all these emails to me, and one came through with an offer to buy the business. So
oh, wow. Okay.
That's how I found out I wasn't the only one.
There you go. Interesting. Yeah. So
but I had that big plan to that I was going to be owner or part owner of a business.
Well, so you've been entrepreneurial, so good on your mum for getting you off the couch and that sort of, and that set the foundations though for you in the finance industry, just learning the basics and stepping up and everything. So, obviously, property's been a big part of your life, right? What's been some of the biggest challenges you faced early on in your personal investment journey, and how did you get started? How did you overcome them?
Yeah, okay. Well, look, saving a deposit was a hard one. And sort of the temptation, I suppose. I've always liked to travel. I love good food. Probably spent a lot more than I should, or should have been in those areas. And I still struggle with this one. This is one that, I think because, to be successful in property or any investment, you sort of got to be disciplined and have good, savings or spending habits. And that's one that I still struggle with today. So, saving the deposit. I was lucky enough to be able to, and not everyone has this, but to live with parents rent-free. I was paying a little bit of board, I think, which helped me to save that deposit. I moved back with them.
How much deposit did you need to save, Luke?
And back then, I got in just before they brought out the 100% home loans. I don't know if you remember those.
Yes,
so
I do.
No deposit home loans.
Yeah.
So I got in just before that. I think I only needed about a 3% deposit.
Wow.
Because I was able to capitalise the lender's mortgage insurance, and I got I think it was a 7,000 first homeowners grant. No stamp duty. So it was a lot easier. But even then, I found that a struggle because of my spending.
It's interesting you mentioned the word discipline, because I come across that too, and it's something that I've sort of adopted in my own life journey. I've always had a budget and save for things and deferred gratification to some degree, but it is, some people go, it's too hard to save, I'll never be able to buy, or it's going to take me a long time. But discipline is hard, but also not buying property is hard. So you've got to choose your hard. You know what I'm saying?
That's right.
And discipline actually leads to freedom. A lot of people think discipline's going to wrap you up in knots and tie you up in chains. In fact, it's like discipline in your life, whether it's exercise or whatever, is a great thing for you. Wouldn't you agree?
I agree. And I actually funded a lot of my travel through property investment. I did a few equity releases once I'd gained a bit of equity.
Yeah, good on you.
To fund those. So, and I'm not recommending that everyone does that, but
you're enjoying the journey. That's great. Yeah. Okay.
I think you've got to take the wins every now and then. Like, you have to be disciplined, but then you also have to have a bit of balance and some fun goals to work towards.
Well, just on that point, I did a presentation to a group yesterday, and my first slide was putting up my wife and I going for a swim with the whale sharks in Exmouth. And my reason for putting that up is that I'm starting now to live the bucket list life. I've got a whole bunch of things on. I've got a whole lot of things on my bucket list, and it was fantastic. And it was it didn't cost the earth, but it was a trek to get there. But it was so worth it. And it's just like, property's been good to me, and property's not an end goal in itself. Like, having property, having wealth through property enables you to do other things. So,
Yeah.
yeah. Luke, I've got another question for you. Have there been any kind of key pivotal mentors or moments or turning points that's really shaped your success as either a broker or a property investor?
Yes, I've had lots of mentors over the years, and pivotal moments. I think, look, if we're talking property, I would consider yourself, and even Chris Gray in the early days. I think you two really got me into or interested in property very early on, back when I was single, no kids again, attending all your seminars. You sort of just explained it in simple terms for someone who had no experience, first home buyer back then, the power of leverage that you have with property. So, I think yourself and Chris were instrumental in those early days. In terms of business and running a brokerage, a big turning point, I think, was when I brought on a business partner. Adam is my business partner back in, that was May 2015, because before that I was just, grinding it out, sort of burning from both ends of the candle, quite successful, but didn't really have a life and was sort of working 7 days, having breakfast, lunch and dinner in front of the laptop and, doing quite well financially, but didn't have a life. So bringing on a business partner really helped me to get some of that time back. And and then more recently, my beautiful wife, I think, she financially, she's not sort of financially savvy, but she keeps me grounded and sort of I'm a 100-mile-an-hour sort of guy, whereas she's a yoga instructor and a teacher and a lot more grounded than me, and so she has to remind me every now and then just to relax and take a bit of a break. And,
That's great.
So I don't burn out.
Yep. Big shout out to our wives. Absolutely. My wife was definitely very pivotal in helping start our business and getting it growing too. So big shout out to our wives out there and partners. I've got another great question for you, which is about mindsets and habits, which I think you resonate with. I'd love to know what particular mindset or habits have helped you in growing your own wealth personally and helping to guide others to do the same.
Yeah, good question. I think for me, I like to keep it simple. It's hard work and setting goals. So, I'm up every morning at 4:15 now. I used to be 5 a.m. club, but I've just done.
Wow, that's early, mate. Hats off to you. Good job.
4:45 on weekends. I give myself a bit of a sleep in.
What do you do in the morning? What do you get up and do at that time of the day?
It's different. So on weekends, it's gym, or I've just started to find my love for running again. But during the week, because my daughters, they wake up probably 7:30, and when they're awake, I like to spend a bit of time with them and have breakfast with them and just relax. I help with the school drop off and daycare and all that sort of stuff, which I love. So I find I'm up at say 4:15. I have my lemon water and do a bit of a stretch and just ease in. I'm probably in front of my computer by 5, but that means from 5 a.m. till sort of 7 a.m. until they wake up, I'm just, I'm tackling those tasks, getting through my emails, setting myself up for the day. I think you or Chris might have given me a book at one of those seminars or advised me to go buy the book. I can't remember now, but it was called Eat That Frog by Brian Tracy. Have you heard of that?
Yep, absolutely. Read it many times. Yeah, yep. Mm-hmm.
Yeah, and one of my favourite quotes from that is, the Eat That Frog itself, it's sort of metaphor for if you get up early in the morning and you tackle your hardest, most dreaded task, that your day can only get better from there.
Yeah.
So that's my mindset. That's what I do every day.
Fantastic.
Wonderful. Early, get the hard stuff done, and then the day is I get natural energy from that.
Yeah, cool. And is there any other wealth habit that you particularly have adopted over the years?
Wealth habits, yeah. So look, I am getting smarter with my investments. I was for a while there, very what's the word? A bit of a dreamer. Right. I used to buy lotto tickets and scratchies and dream of winning the jackpot.
Yeah, right. Mm-hmm.
And then I came across another one of my favorite quotes by Napoleon Hill, which is some people dream of success and others wake up and work hard at it.
Yep. Mm.
So, these days I'm a lot more focused. I set goals that are, both realistic and achievable, rather than sort of just dreaming of success.
Awesome. Yeah,
have to
Right.
set those goals and have something to work towards. For me, that's those goals are usually centered around family, holidays, that sort of thing. That's
Fantastic.
what I'm working for.
Yeah.
And I've achieved that through property and other investments.
Wonderful.
So, taking a balanced approach.
Yeah, great. And if you could go back in time to, say, your 25-year-old self, is there any sort of key piece of financial advice you'd give yourself?
Just be patient. Yeah,
Okay.
just slow and steady wins the race. Don't cave to those temptations, those get-rich-quick schemes or risky investments that are promising those lucrative returns. That's what you know. Bring in a team of experts that handle what you don't know. Broker, buyer's agent, accountant. I think, I was out the gates early and just trying to, retire by the time I was 30. I made a few sort of, poor choices, poor investments that set me back a bit.
Yeah.
So just be patient, slow and steady.
Really good advice, Luke. Excellent. I want to ask you, Luke, I guess, what's the biggest mistake that you see people making when it comes to using finance as a tool to build wealth? And what should they be doing instead of that mistake?
Biggest mistake. One of them that I can think of off the top of my head is listening to parents. My parents probably listen to this and happy for this, but no, listening, or even family, friends, anyone who's just not an experienced investor or has little to no experience in finance and property. And it's something that I see a lot. We do have a lot of young clientele, and they often, even after they've come and spoken to us and we give them some advice, they'll say, "Oh, look, we're just going to go away and have a chat with mum or dad and see what they say." Or they might have just got a loan and they come back and they say, "Oh, Dad's just told me that the loan structure that you put me on is probably not the best structure. I should be paying P&I, or I should be paying weekly. I need to pay my loan off as soon as possible." So they're getting that advice from parents or family or friends who think that they know what they're talking about, but really have very little experience. And that's a big mistake, I think.
Yeah, so watching out for the weird uncles and family members that perhaps don't have their best interest or knowledge at heart. I think it's definitely a good one. Yeah,
they might think that they do, right? They might think that they know, and some of them have made good money out of property, but that's probably more attributed towards hard work, grinding it out, sometimes sheer luck.
Yeah.
They bought a property because they needed somewhere to live, and the property market boomed, and they made money, and now they're an expert.
And it comes back to their beliefs too, like our parents' generation. Like my mum and dad weren't good investors. My dad thought he was a good investor, but he wasn't. Mum had no idea on money matters whatsoever. But I sort of very early on had an aversion to debt. I was always taught early on, if you read, Paul Clitheroe's books and stuff, it's pay off your loan, pay off your home, and then think about investing. But if you take that advice, you're going to miss 2 or 3 property cycles, and then you start buying investment property when you're 55, and it's too late, right? So some of even from the well-intended experts, is misguided, and you just got to be very careful who you listen to. Make sure you find someone who's trustworthy, got the runs on the board, and get the right advice. It's really critical. We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast. Luke, you just mentioned structuring. How important is structuring loans? Like, especially when you're talking about buying multiple properties, in other words, a portfolio. How do you get that right from the start? What does that mean?
Yeah, extremely important to get it right from the start. You can sometimes untangle bad structures, and we do that a lot. People that have come to us after having spoken to another broker, or maybe perhaps their bank has set them up with a loan. But if you can get it right from the start, it's just going to save you thousands of dollars, both in interest and probably tax as well, tax deductible expenses, if structured correctly from the start. we see a lot of people that are set up with, like I mentioned before, principal and interest loans, when perhaps an interest-only loan would have been a better way to improve their cash flow and help them save that deposit for the next property, or paying down, investment debt, or paying down debt on an owner-occupied property that is ultimately, a stepping stone and going to become an investment property in future years. So by the time they've moved out of that property and want to turn it into investment, they don't really have much of a debt to gear. Lots of equity, which is great, but so getting that structure right from the very start is super important.
Okay. So for those just starting out, should you prioritise buying a home, or should you be thinking about buying a first investment property? What do you think should be people's priorities?
Look, that is, I think, case by case. There's certainly some fantastic benefits for first home buyers that I think all first home buyers should consider. There's the first home guarantee scheme, which is 5% deposit, no LMI, stamp duty exemptions and concessions. If you're willing to live in the property for 12 months, but I think you need to be willing to make some sacrifices, and it's still got to be an investment decision at the end of the day, even if it's going to be initially an owner-occupied property. You've got to take the emotion out of it. If you're buying an owner-occupied property because you don't have a sufficient deposit to buy an investment, like you might need to apply for that first home guarantee scheme because you've only got 5%, and maybe you can't afford to pay stamp duty. So, sure, if you can find a property and get in the market sooner rather than waiting until you've saved, say, a 10% deposit and stamp duty, then I'm all for people jumping in and buying their first one as owner-occupied. I wouldn't be buying it just because of those incentives.
Yes, exactly right. And I think also there's also been, I guess, some stigma attached maybe to rent vesting and not buying your own home first. And there shouldn't be that. It doesn't matter whether you're renting or whether you've got an investment property first. As you say, it's all an individual, what's going to work for you in your personal situation. So I think
if you're in the market, I'm sure, and you're in it for the long haul, then you can't go wrong.
Yeah, exactly. Yeah. I talked about sort of my own early aversion to debt, but how do you think buyers can leverage equity safely and strategically scale up property investing?
Good question. I mean, I always speak to a broker first, but you have to sort of know your risk appetite, know your own risk appetite. So everyone's going to be a little bit different there with the level of debt that they're comfortable with. And I was like you early on. I was a budgeter. I didn't like to have debt, didn't like credit cards. But once you learn that there is a difference between good and bad debt, so that bad debt being sort of credit card debt, personal loans, car loans, anything that's going to be purchasing a depreciating asset would be bad debt. But taking a loan to buy property, which is an appreciating asset, if you buy right in the right area, that's good debt. So, knowing what level of debt you're comfortable, what's going to keep you up at night, how secure is your job, all those sorts of things. You've got to ask yourself those questions, because if you are, too big of a risk taker, which I have been in the past, and when you overcommit yourself, I think. It's easy. We get stressed. We get anxious, overwhelmed, and we make bad investment decisions. For example, selling a property prematurely.
Yes. Okay.
So I think just knowing your own risk appetite and what's your comfort level is really important there, and that's where a broker can help you, though. Like, can help you.
I think the other point to make there too is that the banks, in doing their own, and you do this for your own serviceability calculators, no doubt, is the banks have assessed you at like a 3% buffer rate. So let's say the mortgage rate the bank's quoting is 5.5%. The bank's going to do an assessment on 8.5%, and it's extremely unlikely it's going to go to 8.5%, right? So bear in mind that when you do get a number from a broker like yourself, that's that's already got a comfort factor in there. Because I get a lot of people come to me and say, Rich, I can, the bank said they'll lend me 900, but I only want to invest 600. And I'm saying, why? Why wouldn't you want to invest in a better quality asset? What are your thoughts on that?
Or two, I agree. I think, we've got to take comfort in that and take a leaf out of the bank's books. So we actually get sometimes the opposite, people saying, the bank's not lending me enough.
Got it. Yeah, sure.
But the banks are money-making machines, right? They're making money, profit hand over fist because of these buffers they've got in place. They've been doing it for a long time. Not often that you see a bank, go under. You see developers and builders and investors going under all the time, but banks, they know what they're doing. So if the bank's assessed you and approved you for a loan, you should take comfort in knowing that that's
got it. Yeah, okay.
That's affordable.
So yesterday, we're recording this just in early July, but yesterday the Reserve Bank decided to keep interest rates on hold and surprise financial markets. I was very surprised they decided to keep on hold. And the RBA governor's, walking to the beat of her own drum. But interestingly, several members of the board wanted to cut rates. But we are definitely going to be getting more rate cuts later in the year. So in August, it's a 100% definite rate cut coming, and at least one more, maybe two before the end of the year. But with this interest rate cycle coming, how do you think investors and home buyers should position themselves financially now?
Yeah, my advice is actually to try to ignore the noise, right? Don't focus so much on what rates are doing. Certainly don't wait for the RBA or the banks to cut rates before you make a decision. We're talking a 30-year loan potentially. So we know that rates are going to rise and fall over that time. And, as long as we're always borrowing responsibly within our means, I don't think I get clients all the time saying, I'm just going to wait for this next RBA now, see what happens before I decide what I'm going to do. Yeah. But when rates are cut, when the RBA cuts rates, and assuming the banks pass it on, all it does is improves everybody's borrowing capacity, right? Everyone's position. So if you're going to follow the herd, you're going to find as rates come down, everyone's borrowing capacity goes up. Generally speaking, that will push prices up as well. In certain markets. So if you want to sort of not be competing with everyone else, get in when you can with what you can.
So I hear what you're saying. It's the early mover is going to get the advantage. Yeah. And I think if you're worried about rate cuts, don't worry. They're going to come. And as you say, rates will stabilise. They'll move up. They'll move down. But at the end of the day, it's those that actually take action who are the biggest winners, because so many people wait for the perfect time, and there's no perfect time. I guess this also comes down to my next question, which is around getting stuck. Where do you see people most getting stuck with finance, and how can you as a broker help unlock those opportunities that they may not see themselves?
Yeah, look, I think with borrowers, and this is probably something that we see quite often with our younger generation borrowers, sorry, not brokers, is just they're a bit nervous to, or embarrassed almost to go and speak to someone about their financial position, or make the assumption that they're not going to be able to borrow that much. So setting a strategy session with a broker to discuss your borrowing capacity is something that I think is super important, because borrowing capacity is where we see people getting stuck, and it's because often they'll go into their own bank, and they're relying on their bank as their sole source of information, or they'll try to go online to an online calculator and figure it out themselves. But as a broker, we've got access to over 60 lenders on panel, and the tools, the contacts, the technology to within minutes just tell you how much you can borrow with every one of those lenders. And every bank and lender has different set of policy, different guidelines, different rates. So your borrowing capacity could vary a couple of $100,000 from one lender to the next. So that's where I'm seeing them getting stuck, is around that sort of trying to figure it out themselves.
Got it. Tell me more about some hacks that we could maybe share to our listeners today. Is there any sort of an underrated loan feature or a strategy that more buyers and investors should be taking advantage of?
Yeah. So we'll answer the loan feature one first. So loan feature, I think, I don't know if it's underrated, but we don't see enough people taking advantage of it, is interest only with offset, especially for investors. We still see a lot of people trying to pay P&I, which there's a time and a place for it. If you're trying to reduce debt and maybe sort of the back end of your property investment, career or strategy, whatever you want to call it, and reduce debt to sort of own a few properties outright. But in the early days, don't be afraid to pay interest only with an offset. It's going to help you to accumulate property faster. And improve your cash flow, help you to leapfrog into that next one. So yeah, and even with owner occupiers, right? I know a lot of the banks do frown on interest only owner occupier loans, but strategically, if you're living in a property and you know that in the next couple of years you're going to be moving out of that for whatever reason, it's too small, or you want to move location, but you want to hold that as an investment, you can convert that with certain lenders to an interest only. Speak to a broker and an accountant first, or a financial advisor to get the right advice, but you can restructure that loan onto interest only repayments with offset to help preserve cash and build your deposit faster for the next one. That's something it's a strategy that we use a lot, but
it's one that I've done too. Look, I mean, very early on my investing career, I jumped on the investment only bandwagon, and it did really well. Because for me, it was like, late 20s, early 30s. I just want to get as many properties as I can. When I first understood the concept of leverage, I bought 3 properties that year, right? Not a modest income too. It wasn't a high income at the time, but I just went, wow, this is great. So I definitely, again, there's not a one size fits all, but I definitely think that's a strategy to accumulate. And I think a lot of people have gone to P&I, particularly after COVID. I think with the rates being so, and when the differential pricing was brought in, I think that was
when we saw the change. Yeah,
big catalyst. So
once upon a time, they were the same rate, right?
Exactly. Yeah. And what's the difference now? About 0.25, 0.2? What's the difference between IO?
Yeah. It depends on the lender, but about 0.2. Some even under 0.2 difference. It's really not a huge difference.
Not much difference. Yeah. Okay.
But it's a big difference to the pocket. So
yeah.
And then SMSF lending is another one too that I think more people should consider. We see a lot of clients with large balances in super, and talking about the power of leverage. I think a lot of people just look at it from raw numbers perspective. They I don't know, let's say they've got 250k in super and they're looking up sort of average super sort of growth rate, which I don't know what, down 8% per annum, is it now?
Yeah.
Maybe.
Yep.
So I'm thinking, I'm making 20,000 a year on 250, but if you could use that, and I'm not suggesting use that full 250 in that example, but even if you use half of that, 125,000, you borrowed 400,000, you bought a property for 500,000. The extra 25 would be to cover stamp duty and costs. So you're putting down 20% plus stamp duty and costs and borrowing 80. Then you've got a property worth 500,000, and even if it doesn't grow at 8% per annum, even if it goes at 6 or 7% per annum, it's on 500,000, right? So that's what's that? 35 grand a year at 7%, as opposed to 20,000 in super. Plus, you've got the residual balance in super. I just think, that power of leverage in an SMSF.
And the other point to make there is it's not dependent on your personal lending capacity, right? It resets with self-managed super fund. Is you completely reset your borrowing capacity within that entity.
100%, yeah. So we find that most of the clients that we get loans approved for within an SMSF, they're assuming you're borrowing sort of between 70 to 80% of the value of the property and putting down a 20 or 30% deposit. The repayments on that loan are covered in full, in most cases, by the rent and your statutory super contribution. So you're not having to pull out of your pocket to hold it. Okay. So somebody else is paying your mortgage for you. The tenant is paying most of the mortgage, and then the super from your employer is paying the difference.
Luke, how can people fast track their ability to borrow more, especially if their borrowing capacity has been squeezed?
There's lots of strategies that we employ to improve borrowing capacity, reducing credit card limits, reducing personal debts if you can pay them out. Don't do it before you speak to a broker. Often we have a strategy session up front with the customer and tell them how their borrowing capacity could be improved if they, for example, reduce a credit card limit, pay out a personal loan, pay out their HEX debt, cut back on discretionary spending like Netflix, Uber Eats, etc. But we tell the customer, don't go ahead and do that just yet. Just know that if we can get a pre-approval on the under the provision that you commit to that. Get the bank. In our credit notes, we'll tell the bank that the customer is willing to reduce their credit card limits. They are willing to pay out the personal debt, but don't do it until you actually get approved. But the strategy session with the broker is important there, and also just reviewing other options, like looking beyond the mainstream lenders, because a lot of the mainstream lenders, like you said, have those 3% buffers. There are other lenders out there that have 1 or 2% buffers. You might pay a high rate, but
I was going to say that I guess the key thing here to talk about also is people's incomes, right? Income for me is the most
Yep.
singular high determinant of what you can borrow. Like if
Yes.
you're earning 100 grand versus 50 grand versus 300 grand,
Yep.
each of those three examples I just gave then are going to have vastly different borrowing capacity. So when I get
Yep.
asked that question, Rich, how can I improve my borrowing capacity? I say, improve your skill, improve your value to an employer, right? When you do
Yeah,
that,
that's
go and
right.
get training and increase your own, like invest in yourself. And this is not an overnight thing. This is a long-term thing. So this is like getting educated. Like, I went to uni and did economics and I had a job in government for a bunch of years and I got sick of it, but I upgraded my skill as I went along. I kept on doing courses, additional courses, doing a master's degree and stuff. But as you become more skilled, then you're going to be paid more and that helps you to borrow more. So I think, yes, you can reduce your credit cards. Yes, you can, pay off your car loans and that sort of thing. But I think fundamentally, try to get a better job and improve your skill set. What do you reckon about that idea?
It probably ties back to your thought of the day, Rich. Like,
Yeah, true.
um, how powerful is the mind, right? You've got to believe in yourself and believe that you're worth
Correct.
more.
Yeah, yeah.
Um, and know that you can earn more because we hear that a lot where people sort of
Mm,
I don't know, they sort of put a ceiling above themselves, right? Like
mm,
this is
mm.
as good as it gets. This is as much as I'm probably going to earn. Maybe I'll get a 3%
Yeah.
CPI increase if I'm really lucky. But
That's right. Yeah. And you can't
yeah,
just
so
ask your boss for a higher raise. You can't just say, give me more income. You've got to show value, right? So
that's right.
if
Yeah,
you're delivering value, then people will pay you more. But can you
that,
walk us
that's right.
maybe through an example of a real life example of where a client has used finance creatively to build significant wealth that maybe you've assisted?
Yeah, yeah. We've had a few recently where they've come to us for advice. They've paid off their principal place of residence or significantly reduced the debt that they've got against their principal place of residence. And we've been able to extract equity from that principal place of residence. We had one client recently that bought 6 properties within 6 months,
Mm-hmm.
all sourced through a buyer's agent.
Mm.
Um, 2 of them were blue chip properties and 4 passive income. So they sort of
Excellent.
created, and I think I might have heard this concept through you
Mm.
initially in those
Mm.
early seminars, but sort of created a bit of that property hub.
Mm.
I think that's what you call it. But
Yep.
2 blue chip properties that were negatively geared, so the rents were not quite covering the mortgage repayments,
Mm.
and then 4 that were passive income where the rent was exceeding
Mm.
the
Yep.
rent the mortgage payment, sorry,
Mm.
and covering the shortfall on those blue chip properties. But
Mm.
yeah, the strategy we used there was quite simple: release equity from the principal place of residence to fund 20 to 30% deposits on the purchases, and then borrow 70 to 80% on each property,
Mm.
keeping them all standalone, maximising the tax benefits because effectively that way we're borrowing the full purchase price plus the stamp duty plus the costs. There's no money out of their pocket, so we're preserving access to the cash that they have in savings for a rainy day, or they might need a car upgrade in future years, putting kids through school and all that sort of stuff. So that's a strategy that we use effectively quite often.
Really good. Another point I'll just pick up there on your example, you talked about that client buying 6 properties, two
Yep.
negatively geared, neutrally geared, growth properties, and the others more balanced. It is important to get the balance right in your portfolio, and that will determine how many more properties you can buy. So it comes back to this overall strategy. So listeners out there need to understand you've got to work with both a fantastic finance broker and an investment savvy buyer's agent to help you get the right strategy up front. So we help clients based on where their current situation. We look at say, hey, do you want to retire on 200 grand a year? Then you're going to need to get, $4 to $5 million worth of property over the next 15 years. How do we get to that $4 to $5 million? Okay, so let's buy this type of property in this location. Let's get the growth under your belt. Let's focus on the equity building. And then as you run out of squeezing your borrowing capacity, let's get some more balanced properties or positively geared properties that can help boost your borrowing capacity. So it's not just buying one type of property the whole way through. It's super important to
No,
get the
no.
balance right.
And the planning is really important. So
Mm,
yeah,
mm.
point out these were all sourced through a buyer's
Yeah,
agent. We
yeah,
had strategy sessions,
yeah,
like
yeah.
multiple strategy sessions before they even bought the first one.
Yep.
It wasn't like let's buy one and see what happens, and then buy another one and see what happens.
Yeah.
It was well planned.
Yeah, great. I want to ask you about fixed rates. Is anyone fixing their rates at the moment? Is there any particular rules of fixed versus variable that you live by?
Yeah, look, we're not doing a lot of fixed right now. We were Pre-COVID, there was quite a few
They're coming down at
people
the moment, so why would you fix it, right? You know. So,
Yeah. Look, I've personally only fixed twice in my lifetime and got it wrong both times. Because you're betting against the banks, right?
That's right. Exactly.
Ultimately, they've got a lot more time, money, and resources to throw at it. So if you're taking a fixed rate, you're gambling against that research.
I did the fix just on that, Luke. I did the fix just during the COVID period when the rates were at emergency levels. I fixed for 3 years at around, I think, 1.9 or 2%. Can you believe it? So I wish I'd actually taken out the 5-year rate. That would have been even better. But anyway. So.
I know. In hindsight, I got greedy and I didn't. But I think there's times when fixing makes sense and there's times where it doesn't. And it really, again, it's case by case, depends on the individual, their circumstances, their risk appetite. If you've got somebody who is perhaps in a, maybe single parent in a job which they don't consider to be really stable or safe, they've borrowed to their maximum to buy a family home or an investment property and are living paycheck to paycheck. Not that I would encourage anyone to do that, but there are people that do it. Then fixing probably makes sense for them, right? It helps them sleep at night. But if you've got somebody who's borrowing well below their borrowing capacity and got multiple investment properties or a well-diversified portfolio and a couple of $100,000 in offset, well then why would you?
Yes.
You can afford to ride out those highs and lows.
Yeah, cool. And Luke, what finance habits separate the average buyer from the savvy investor in your experience?
I think we touched on this earlier. I think discipline. So discipline with spending and savings is a real big one. That's where we see our more savvy or successful investors tearing away from the pack is they're just very disciplined with their spending, their budgeting, willingness to take calculated risks, so not being afraid of debt. A lot of the, let's say, average buyer or average investors are sort of afraid of debt to some extent. Their risk appetite is very, very low.
Yes.
And then patience and research and surrounding yourself with an expert team.
Yeah, perfect. Great advice. Almost finished, Luke. Got a couple more key questions for you. If someone's listening to this podcast today and they're kind of unsure about how to even get started, what's one thing they might be able to do this week to move forward financially?
Just reach out for a free consultation with a broker, a buyer's agent. Don't be afraid or embarrassed. I know I was very early on before I got into property investing. I think I was, in my mind, I wasn't really on what I thought a respectable income. So I was sort of afraid to go and have that meeting because I thought I'd be laughed at. Yeah. But with our strategy sessions, we always send the customer away fully understanding all of their options. Sometimes they are surprised and they can borrow more than what they expected. Sometimes it's less than what they expected, but we'll never, laugh at someone and say, what are you thinking? Why waste my time? It's always a good strategy session where we talk about what their borrowing capacity is now. If it's not where they want it to be, what do they need to do to get to where they want to be? How much do they need to improve their income by? How much do they need to improve their deposit by? Yep. And giving them a clear plan and strategy to execute on.
Great. And Luke, how do people find you if they want to work with you? What's your website? How can they get in touch with you?
Yeah, well, I'm sure we'll probably link to this in the notes, but the website is www.loansforhomes. That's with a number 4, so LOANS number 4 HOMES.com.au, or give us a call 1300 476 188.
Fantastic. And Luke, one final question for you. What's the best piece of wealth building advice you've ever received or been given?
Mate, I don't know who coined this quote, but I think I heard it from you. And it's the deal of a lifetime comes around once a week. Was that
memory.
you?
It was me, mate. Absolutely. You've got good memory. Yep.
Yeah. So, don't rush to jump in because you think you're going to miss the market. There's always other emerging markets. Yeah, you might have missed out on Vaucluse, but there's going to be another market emerging where there's spending on infrastructure and population growth. So Don't worry if you think you've missed out, and don't don't worry if you think you found the perfect property but missed it at auction because someone had a bigger budget and bid higher than you. There'll be another one equally as good, if not better, next week.
Fantastic. Well, I've been speaking with Luke Gardiner, CEO of Loans for Homes. Luke, thank you so much for your time today, sharing your knowledge. We really appreciate it. Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry and we'd be delighted to help. Please visit our website at propertybuyer.com.au where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer podcast.